Well, good morning, and I want to welcome everyone to another one in our webinar series, Tax 101. Today's topic is going to be the Canadian taxation on non-resident athletes. My name is Steven Flynn. I'm a partner with Andersen in Vancouver, and I'm joined by my colleague, Brandon Vucen with Trowbridge in Ontario. Brandon, why don't you introduce yourself and tell us a little more about your practice in Trowbridge?
Yeah, thanks, Steve. Thanks for inviting me to this day. Very happy to be here. I'm a director at Trowbridge in their private client services area. Part of my practice is dealing with athletes, whether they be non-resident or non-resident. So a big part of our practice is in the athlete area, some coaches as well. We also work with some minor league players on the hockey side. So it keeps us busy.
Absolutely. Great to hear that. Trowbridge is a collaborating member of Andersen, has been for a couple of years, and we've gotten to know them since they joined a couple of Septembers ago. So great to have you today. And we'll do a little bit of housekeeping here. If you want to flip to the next slide there, Misbah. We encourage audience participation, both with any questions you may have. Brandon and I are going to leave some time at the end to answer any questions. You can put them in the chat box there, and Angie Feng, one of our managers, will kind of go through those and read them to us. As always, the material counts for professional development, and so we've got some polling questions that we'll go through during the presentation. As long as you're answering those on a timely basis, you should be able to get credit, whether it's CPE, CDE, whatever you call it, for your various society. At the end of this, we have a survey. We're always trying to seek new topics and new areas that our viewers and our listeners are interested in hearing about. So please complete the survey to give us that feedback. And if you want to hear a live transcript, there's a closed captioning button. You can click that there as well. And happy to do that. Next slide, please. We'll just go through some of the items on our agenda today. In the next hour, we're going to talk about the taxation in Canada of American athletes that are playing here, whether they're with teams that are in leagues or whether they're independent contractors. We'll talk about some of the strategies that can be used to lower Canadian tax, or at least to make sure we get a coordination of the two countries' tax laws, whether that be through one of the Canadian pension strategies of a retirement compensation arrangement, whether we look at how you allocate income when you're playing for a Canadian team and you're a US athlete. Whether that's allocation of income over the days you work, the practice days, even before you sign with a Canadian team, how are signing bonuses treated and what's the special relationship there. And then we'll talk about some recent assessments. And Canada Revenue has been very active in the last 5-7 years on the taxation of athletes. And there's a couple of very high profile cases here that we'll talk about. Before we jump onto this, back in March, I wrote a blog on the taxation of movie stars and athletes, and it covered a bunch of different ground. And as part of that blog I wrote in March, I talked a bit about state taxation and its impact compared to Canadian taxation on athletes and where they choose to play. And actually, on June 2nd, the Wall Street Journal picked up the same kind of theme. And their conclusion when it came to hockey and it came to the Stanley Cup Finals was that players and their agents and their families are more geared to play in low tax jurisdictions when they have a choice. And if that's the case, then you'd see success on the ice. And sure, if you look at the last many years of results, the Stanley Cup Finals, you see that teams that are based in lower tax jurisdictions, the Tampa Bay Lightning, the Las Vegas Golden Knights, where there's zero state taxation on a low tax on athletes, they're the teams that are winning Stanley Cups compared to Canadian teams. And it's somewhat well known that a Canadian-based NHL team hasn't won a Stanley Cup in forever, are higher taxation, jurisdictions and are not winning Stanley Cups. And so far, Stanley Cup Finals after Game 2, it's low state taxation 2, high provincial and federal taxation 0, and that's the result so far, Brandon. I don't know if that's going to continue. Not my place to predict things, but it's a maddening trend for Canadian hockey fans. So go ahead, Brandon.
Yeah. Sorry, I like that. I like that jab at the Maple Leafs. Thank you.
it wasn't attended to. As a Canucks fan, I suffer as well. The next slide, then I'm going to turn it over to Brandon. Brandon's going to talk about some of the basic concepts of Canadian taxation US athletes. Go ahead, Brandon.
That's great. Thanks, Steve. So the big thing for US athletes that are playing in Canada is really that determination of whether they're a resident of Canada or not. So in general, US athletes that are playing up here, again, if they're a non-resident, they're generally taxed on their income up in Canada, really just taxed on Canadian source income. So that's essentially wages for services performed for the team that they're playing on. They might potentially have some business income that they might derive in Canada, and also potentially dividends that they might receive from Canadian corporations, but is kind of beyond the scope of this. That essentially is income that's taxed under Part 13, so not really part of this. But again, the biggest thing is the determination of residency, which ultimately leads into how a non-resident would be taxed on, let's say, their wages playing for a team. So a few kind of issues to explore there is, firstly, there is one looks at the domestic tax law, let's say both Canada and the US or any other countries. So the issue is under Canadian domestic tax law, would a athlete that's playing up here for a Canadian team, would they or could they possibly be considered a resident of Canada, which would be a negative outcome for them, since obviously, as Steve mentioned, the tax rates are higher up here. So that would definitely be a disadvantage for them to otherwise be considered a resident of Canada. So the residency determination in Canada, CRA takes two approaches. One is what they call deemed residence, and secondly is what they call a factual resident. So again, in our, with our client base, it's possible that a player may be up here for more than 183 days, be considered a deemed resident, but otherwise through other means would be considered to be a non-resident. So a deemed resident is basically if an individual is in Canada for 183 or more days in a year, then they're considered to be a resident for the full tax year. So again, you can see a scenario where someone may kind of bump up against that, or may otherwise come to that line. The CRA also looks at whether someone is a factual resident. So when they're looking at a factual resident, they look at a number of different factors, and they kind of break those up between primary factors and secondary factors. The primary factors would be, where do I have a permanent home? Where does my family reside? Where is my employer located? Usually if you have one or two of those, it's hard to say that you're not a resident. But again, for most non-resident athletes, they wouldn't necessarily have a permanent home up here. And then there's also secondary factors, again, not as critical, but when you kind of take them in conjunction, the primary factors, or the primary factors, lead you to both Canada and the US, the secondary factors may have more impact. So that would include things such as, where do you have health insurance, bank accounts, credit cards, investments, where is my car registered, where's my driver's license from, which state or province, if I belong to any of the social clubs. So again, in that scenario, someone, if they're not otherwise a deemed resident, might be considered a factual resident. Now, in that scenario, where let's say a US athlete is considered to be potentially a resident of both Canada and the US, and you can't be a resident for tax purposes. You shouldn't be tax resident in two countries. The tax treaty between Canada and the US does provide for what they call tiebreaker rules. So basically, the treaty, they look at a few different things to determine to which country do you have a closer connection. So again, in that scenario, the treaty provides where do you have your permanent home, where is the center of your vital interests, and again, that's something similar to the secondary factors, as to sort of the bank accounts, and again, sort of where you tend to reside most of the time, or where you have a habitual abode. And then if you really tend to have, in terms of tiebreaker, if you tend to have kind of those factors in both countries, you may land ultimately which country the person is a citizen of. Now maybe you've got a dual citizen, so now beyond that, you've got you're really tied in there. And then finally, there could be a competent authority resolution. I've never seen that done in practice. I'm assuming, Steve, you haven't seen that either, but um, you know,
No, my old partner, or retired partner Warren Duke used to say, with all these tiebreaker tests, if you can't break the tie and you have to go to the competent authority, you've failed as an advisor. And I always took that to heart. I think this is really important to understand residency, because for a lot of athletes that play on teams where the seasons are long, and you think of anything from Major League Baseball to the NHL, and you get into the playoffs, and maybe again, if you're a US athlete and you're playing for a Canadian based team and you're physically in Canada for a long time, then you really got to get close to that line to say, well, how many days, what's your habits, what are you doing in the off season, are you part of a community program, are you staying in Canada in the off season? Like, all these things have a real difference, and you can really get close to that line. But the Canada US income tax treaty can save you even if the season runs long, by saying as long as your habitual abode is in the United States, then you wouldn't be a resident of Canada.
for sure.
Yeah.
So now we're, on the assumption that the person, the athlete, is a non-resident of Canada, then the issue becomes, well, how do you tax the income that they're earning from the team, or how is their income, I guess, sourced to Canada, based for the time that they play with the team? So kind of a long-standing concept is duty days with the hockey team, which is basically the regular season and playoffs. And I believe it also includes a preseason, but basically it's the time that you need to report to the team. And then again, at the end of the season, when you're no longer required to be with the team. So again, those are sort of your duty days with that team. So usually the team, they will kind of track duty days for the athlete, and they'll provide them some type of correspondence at the end, as part of their tax package, some kind of letter. They may provide a schedule, which basically outlines, they had X number of duty days in the year, say it was 200, and you had, 120 of those were in Canada, and they would prepare their Canadian tax return as a non-resident. They would prepare their Canadian tax return on that basis that 60% of their wages were allocated to Canada based on duty days. So since they're non-residents, those tax returns can't be e-filed, so they're paper filed. So normally we would attach that correspondence and information with the tax return, which basically shows the calculation of how we allocated the income to Canada. And again, my experience has been that I've never had any kind of pushback in that area. Fortunately, I've had a few clients that are not athletes that actually do always get like a T1 review when they're kind of doing something similar where they're allocating days between Canada and US. But in the athlete context, I've never really seen it challenged. The other thing I would mention is, even though the team does provide that information as, a tax advisor, preparer, you should kind of scrutinize what the team is preparing, and just to make sure that it seems reasonable. So, for example, where maybe an athlete was injured in the tax year, so maybe, for example, like Alec Manoa, where he was last year, where he was like rehabbing in the States and not necessarily Canada. So it would seem likely that he would have much less duty days in Canada based on that. There's also when we went through COVID, and how the NHL played in a bubble in Canada and the NBA played in a bubble in Orlando. So again, for those US players who are playing for Canadian teams during that time, they would have many, many more duty days allocated to Canada, whereas players on the Raptors that were playing down in Florida all of a sudden, had minimal or no duty days allocated again. So in that tax year, they actually, some of those players, I'm not saying they were happy, but I'm saying that they actually, were much better off from a tax perspective. And then also, kind of in terms of the duty days, you need to consider when, let's say, there's a termination of employee and potentially a contract buyout. Sometimes what the employer will do, they'll do a salary continuance where they are continuing to be paid by a Canadian team, and now all of a sudden they're living in the US and are not really performing any services. in Canada anymore. So the duty days calculation gets skewed. So there was actually a case, the Dave Nonis case. He was the former assistant GM of the Maple Leafs, where his contract was terminated, but he was paid over time. So in 2015, he only had 37 duty days. And then in 2016, he had 0 because he didn't spend any time working up here in Canada, since he wasn't performing any more work for the team. So CRA actually reassessed him and said it's really more of a, I guess they try to say that to maybe average out the days over sort of some prior years. So they're trying to come up with some kind of mechanism to put more income into Canada. But ultimately the taxpayer was successful because the minister said, well, we're kind of going against our long-standing concept of allocating for a regular person that's earning income in Canada and the US. We're kind of going against the position where you would allocate income based on where the services perform. So ultimately, Dave Nonis did win in that case. And actually, I did have another client that was retired, a Canadian resident, and then he retired, and then like the next year, he received a residency questionnaire from CRA, which I thought was unusual because all of a sudden he didn't, I guess, have that large income from a team, and somehow they assumed he wasn't a Canadian citizen, so maybe they assumed he had moved. But anyway, I was surprised to see that, but ultimately things worked out in that scenario. Next slide, please.
Yeah, that's great. Just on that, and I think if you just go back to that previous slide, one of the things to clarify here, as Brandon talks about this, his fact situation is U.S. or non-resident athletes, U.S.-based non-resident of Canada athletes that are playing for Canadian sports teams. So this would be the Blue Jays, the Raptors, the 7 NHL teams, perhaps a Major League Soccer team or a National Lacrosse team. That have games in both countries. If a U.S. athlete is playing for a U.S. team, unless they're residents of Canada for some reason, they're not subject to Canadian tax, even though the games are in Canada. So, for example, Stanley Cup Finals, the series comes to Edmonton for Game 3s and 4. The Florida players that are U.S. or non-residents of Canada aren't subject to Canadian tax, even though the games are in Edmonton, due to the provisions under the Canada-US income tax treaty. So we're solely focused on U.S. athletes that are playing for Canadian franchises. Go ahead, Brandon, next slide.
I believe actually in was Edmonton or Alberta a number of years ago, right? They tried to bring in some type of a jock tax, right? If I recall, it just kind of died.
It was short-lived. It was a couple of seasons where the province of Alberta had a percentage tax on that scenario, and that faded pretty quickly. That's right.
Yeah. So now we've got the non-residents. They've kind of calculated the amount of income allocated to Canada. Since they're still employees, they're limited in terms of what they can deduct on the Canadian tax returns. So, for example, they can deduct union dues that are paid to the NHLPA, agent fees, not deductible. They can deduct some business expenses if they have income from endorsements that they're otherwise reporting in Canada, so they can deduct necessary expenses against that. And that would also include agent fees if that's kind of related to the endorsements. In the US, prior to Trump's tax reform, or in the United States, prior to Trump's tax reform, athletes were able to deduct employee expenses, which included agent fees, but they have not been able to since then, which actually had a huge impact on most athletes in the US. In terms of income from endorsements, depending on the significance of the income, there could be the potential for maybe setting up a Canadian company to maybe defer some of the income in there, although since it probably would be owned by a non-resident, it'd probably be a higher tax rate, so it may not make sense from a current tax perspective. There might be some deferral, but again, something just to consider, something to consider, again, depending on the significance of that. Next slide. Okay, so we're doing so first polling question. What elements should be considered when determining taxation of non-resident athletes? Canadian tax law, US tax law, Canada-US income tax treaty, or all of the above?
And it just, I think the polling question just kind of highlights how complicated these areas are and all the different aspects you got to consider. We haven't addressed state tax law yet, and we'll maybe talk about that a little bit later. But as Brandon pointed out, Alberta years ago tried to have an athlete tax on games played in that jurisdiction. In contrast or in converse, many states don't necessarily follow the Canada-US income tax treaty, and so even though a Canadian athlete playing for a Canadian-based team that's a resident of Canada may be having games played in the US and may not be subject to federal income tax, they could be subject to state income tax. And so, hey, great to see that. So, terrific. So we'll move on to the next slide. And we'll talk about some strategies here. We'll talk about some strategies. And to frame the problem, as I talked at the start on, different levels of taxation, Canadian tax rates for individuals can get as high as 53.5% in places like British Columbia and Ontario. And that's your combined federal and provincial tax rate. That's much higher than the top marginal tax rates in a lot of the US areas. The top marginal federal tax rate is 37%, and your state tax that's added on top of that can be anywhere from 0 in places like Nevada and Florida and Washington, or it can be as high as, say, 10 or 12% places like New York and California. But even when you add those up, your total combined US federal and state rate can be 8 to 10 points lower than Canada. And more importantly, it starts later. Your top marginal tax rate in Canada kicks in at about $250,000 a year Canadian of income, whereas in the US, it could be 2 or 3 times that, depending on your family situation. So there's a significant gap and much higher taxation for US athletes that choose to play for a team in Canada versus US. So given that, we want to talk about some strategies to help them. And so one of the common strategies you see are something called retirement compensation arrangements. And the way these work is that you can get a deduction from your salary for funds contributed to an RCA plan, as almost like it was just a regular pension contribution. And so, like an RRSP, when you defer that money and put it away, you can get a deduction for it. You're not taxed on it currently. Unlike an RRSP or any kind of pension plan, a retirement compensation arrangement requires a prepayment of 50% of what you put away. So it's not a cash flow savings at the start because you're taking some of the money and you're parking it with Canada revenue, but you're setting it up in a retirement compensation arrangement that you can invest and you can make those decisions. It's not necessarily something that's kind of locked in that stays there. You've got some choices when you want to pull that money out. Next slide. There's some other advantages for RCAs. They can be creditor proof. As I said, you've got some choices. The biggest advantage, though, is twofold. One is there's a rate differential. And so if you're at the top marginal tax rate in those jurisdictions like Ontario or British Columbia, where you're paying 53.5% on every next dollar, instead of paying 53.5%, you could pay 50%. Well, there's a little rate differential savings in there, and that can be sizable over time as your income's higher. But also, when you withdraw funds from the RCA, and the slide should say, if you withdraw the funds and you're not a resident of Canada, the tax rate that you withdraw the funds on is 25%, and it's a flat rate. And more importantly, as you withdraw funds, you get a portion and eventually all of that 50% you prepaid up front. And so you get all your money eventually, but your effective tax rate can be half of what it was if you didn't do this. And so this is a very common strategy you see, not only for athletes, but you see it for executives. You see it for high net worth individuals that might spend time temporarily in Canada. This is a way to, potentially defer a little bit of taxation if you're in the right province, but more importantly, have a real overall savings when you see that. So when you participate in these, so you see these strategies with NHL players. You see them with Major League Baseball players. You used to see them with NBA players when the Grizzlies and the Raptors came into the league in the mid 90s. At some point in time, I think over the last 10 years, the NBA recognized that RCAs actually provide a pretty significant win to the Toronto Raptors compared to, say, teams in New York or California. And so in the most recent collective bargaining agreement, and I saw this article in Globe and Mail, the NBA cut them out. The NBA doesn't allow them anymore and hasn't allowed them for some time. So they're there. We'll talk a little bit later about how these are really supposed to be a pension plan versus an in and out. And Brandon's got an interesting example of a couple of Blue Jays players that got into some trouble with RCAs that it's now common knowledge in the national media that they're fighting CRA for certain amounts of money. Next slide.
Yeah, Steve. Sorry, I just
go ahead,
wanted to, yeah. In terms, you're right, obviously with the NBA, but my thought has always been it kind of took away the disadvantage that the Raptors had compared to some other teams, but obviously the NBA doesn't see it that way. But the one thing is now when you see how high the coaches' salaries are, they're not really part of the CBA. So we've had
interesting
opportunities that we've kind of pitched it to some coaches because they're earning quite a bit, so they still would be entitled to that. The other thing I would say is, I mean, in terms of what is your threshold in terms of like kind of the minimum salary for someone to do an RCA? Any thoughts on that?
Well, there's costs both on an annual basis and just a setup basis, and so if you're trying to defer $40,000 or $50,000 a year in this strategy, I think the costs are going to eat up any benefits. So when we've looked at these are players that are making a few $1 million a year or more, but more importantly, they're willing to set aside that money. And I think as the athletes and their families kind of talk about what makes sense for planning, as we all know, these athletes have very short careers, and if they can get in a sense to say, I'm willing to park this money and invest it, and not only invest it and go through the strategy, save tax, but to leave it there over time as a secondary pension, if you will, because the leagues will have pension plans for them. I think they could be very valuable, but the dollars have to be, I think, much more significant than an RSP or any kind of annual limit.
Oh, for sure. So would you say a rule of thumb is like maybe 2 million, or is that?
Yeah, I don't know that I have one, Brandon. I would just say, it's always a cost benefit thing, and you've got to kind of go through all the facts that say how much are you willing to defer, how much you're willing to put away, what are the costs, and as Brandon will talk to you about, if the athlete or the individual says, well, I want this money as soon as I leave Canada, that could create a real problem that could be much more expensive. Some of the other strategies are, again, for a non-resident Canada athlete, again, we're going to use a US athlete that's playing for a Canadian-based team, is how do you allocate income to Canada? Like, what's the formula and how do you go through those calculations? Brandon talked a bit about this, that it's really based on your duty days. And that's really a definition of one of the days, that you're reporting to the team and playing for the team and performing services for the team, whether that's a game, a practice, a community appearance, or anything that's related to a requirement under your contract to fulfill the obligations of your contract. And it generally starts from the moment of the preseason starts to the end of the playoffs. Years ago, there was a case and it involves it was Stemkowski, and he was a player, and I'm going to go in memory here. I think he played for St. Louis in the 70s, and his the argument there was that how do you allocate days in the off season when you're working out, when you're training, and the conclusion was generally that unless your contract specifically talks about your need to perform certain duties in the off season, and that those duties would be in the team's facilities in their hometown, that's the only time you would include these duty days in that calculation. So in general terms, your off-season days aren't included, but your in-season days are. Interestingly enough, that general formula includes practice time, game time, regular season, playoffs, preseason. And that's, for contracts that are worded that way, that you're paid kind of regardless, or no cut contracts. There's an interesting case, and it's a 2004 case in the tax court of Canada that involved a football player. And this one was close to my heart because I grew up in Regina. I am still a big Rough Riders fan. Ken Austin was the quarterback of the Rough Riders in the 80s and 90s. He won a Grey Cup there as a player. He won a Grey Cup as a coach. He's well known there. And he won on the field, and he even won off the field in the tax court of Canada. And his argument was, when he played for Toronto and Winnipeg, at that time, 25 years ago, the CFL had franchises in the United States. And so there would be home games, 3 or 4 games a year played in places like Birmingham and Sacramento where they had teams. Ken Austin was not a resident of Canada. He was playing for Winnipeg. He was playing for Toronto. He was playing for Canadian based teams. His argument was that his contract dictated that he was only paid for the games he played in, that he wasn't paid for practices, he wasn't paid for preseason. And so when he did his allocation, when he filed his tax return, his conclusion was that he should only allocate income to Canada based on game days. And in this case, in an 18-game season, it was 14 or 15 games, as opposed to if he was forced to do it under the duty days, under the normal way to do it, you'd include practices and everything else in preseason, it'd be a much higher percentage taxed in Canada. Ken Austin was successful at the tax court of Canada, and the judge concluded that it was the unique nature of the contract in the Canadian Football League that was dictated on game days and really was a performance-based, or you could be cut at any time type of contract. And so doesn't really hold much now because the CFL doesn't have US teams anymore. If a league had those types of contracts, and I don't know if the National Football League has those type of contracts, or even if they would expand to Canada, or perhaps Major League Soccer, or perhaps lacrosse or something else has those type of contracts, that could be another way to do an allocation that could lower the amount of income tax in Canada.
Yeah, I think Steve, sorry. Yeah, I think Major League Soccer, from what I've seen, for some of the ways they do things, they seem to do things based on games played.
Oh, really? Okay.
As opposed to duty days, because I assume that just because there's so much kind of inner movement between, I guess, being in Europe and coming over. So that's kind of what I've seen on my end with Major League Soccer.
Well, and I think it really can get confusing when players are traded mid-season, when they're injured. How do you track those days? And when we've worked with clients before, we just make sure we've got a really good calendar of track your whole year as a player. Where were you on that day? Were you traveling? We got to include our travel time. We got to include practice days. We got to include game days. We got to include certain things in the postseason. I'll give you a great example later on how we did something in the preseason that really helped too. So you want to be able to do these things. We, Brandon and I think want to recognize a couple of our colleagues here in the industry, Darren Rouse and Bruce Sprague from BDO. They wrote an article in the Canadian Tax Journal this year on the taxation athletes, and I think we both were joking that we read this article. I've known Darren for a long time. I messaged him this month, and a lot of the stuff that they wrote, I think, was a really good article, and we've used some of it here. So thank you to both of you for that. Next slide. Brandon, do you want to talk about foreign tax credits?
Yeah, for sure. So now we've kind of gone through, the methodology behind, how the wages are allocated to Canada for a non-resident athlete. Obviously, the taxes are paying up in Canada in general, are higher tax rate than in the US. However, since that US person, or let's say citizen or resident, is reporting their income in the US on a worldwide basis, they do get a foreign tax credit for what they've paid up in Canada. Unfortunately, because the tax rate is higher in Canada, they're not getting essentially a full tax credit. So as Steve mentioned, if the individual is residing in a no state tax jurisdiction, like Florida, Nevada, Texas, I think Metro Washington, essentially, on that Canadian sourced income, the person's going to be paying tax at say 54 or 53%. Whereas, the non-Canadian sourced income that he's getting is going to be taxed, let's say, at 37% in the US. So there's definitely, a disincentive and definitely tax leakage for a, oh geez, sorry guys, I'm getting a sorry, old hockey injury, getting a cramp. So there's definitely some tax leakage, and especially in certain states, they don't allow for foreign tax credit. So you may get a 37% tax credit on the federal side, but most states don't allow a foreign tax credit paid for taxes paid to a foreign jurisdiction, which would include a province. So kind of going back to Steve's comment, where a Canadian hockey team has not won the Stanley Cup since 1993. I recently, well, not recently, but I did read an article. There was a professor in, I believe, Western University. He actually wrote a really good article, and he thought that let's say the ceiling or the upper level of the NHL salary cap should be done on an after-tax basis, so that it essentially put everybody on equal footing, in terms of kind of the net after-tax return. And again, it would definitely obviously benefit the teams, that were willing to spend up to that much. It would definitely benefit Canadian teams. And again, you don't necessarily have to, raise the floor of the salary cap, so the teams that don't want to spend that much, they can still do so. I thought it was a really good article. I attended it was a primetime sports event this past year, and I was speaking to someone, not at the league office, but one of the lawyers, and I was trying to, trying to see, trying to see if we get some traction in that area. But I don't, I would imagine there's probably not much appetite for that. But again, I think in some ways, it makes a lot of sense for, again, those teams that are, willing to spend up to that. Now, obviously, the retirement compensation arrangement does help, but ultimately, I think it's more of an issue with the NBA, where the salaries are that much higher, and most of the players tend to be from the States as opposed to Canada. So again, I'm starting it now, so we're gonna work our way on that. Next slide.
I think we've got our second polling question here. The polling question in front of you is, what's the most common method of allocating income to Canada for Canadian taxation for non-resident athletes? You get three choices there. You get game days, it's your first choice. Game days and practice is your second choice, or regular season games only is your third choice. I got a great example of this years and years ago, working with a US-based athletes who's non-resident Canada for a Canadian team. And the family gave me their allocation of all the things I talked about. What are your game days for the year? What are the practice days? What are the travel days? They gave me this whole schedule, and they didn't fill in the preseason. And I happen to know something. I said, I remember seeing something that this team did their preseason overseas. And they said, yeah, you know what they did? I said, well, did the player go? It says, oh yeah, no, they played in both games overseas. They had, 10 days of practices. I said, that is foreign source income, and that is non-Canadian source income. And we were able to do our allocation, including that preseason that would normally have been in Canada, that was overseas. And in the end, probably saved them $100,000 of Canadian tax overall. It was a lucky result, but a terrific result for them. So the answer here, and I appreciate as I look at the question, wasn't as well worded as I could have been, but the point here is it's number 2, which is game days and practices. It includes playoffs, it includes preseason, includes practices, includes travel, it includes everything from the moment the preseason starts till the last playoff win or loss. Next slide. One of the other things that you see often between US and Canada is signing bonuses and how they're treated. And this has a real opportunity for US athletes that are signing with Canadian teams. And that is that under Article 16 for the Canada-US Income Tax Treaty, if a US player receives payment defined as an inducement to enter into a contract or an agreement to then perform services for the team, that is taxed differently than ordinary income. Ordinary income in Canada taxed at marginal rates anywhere from kind of 21 to 54%, as we talked about. But if it's a signing bonus and you receive the signing bonus as a player as an inducement to sign that contract, it's taxed at a maximum rate of 15%. And the rest of it isn't subject to Canadian tax. It'll be subject to US tax because you're probably a US resident, could be subject to state income tax. But the theory is those rates are lower than if you were taxed at 54%. So to the extent you got a contract and you can allocate some of this contract to a signing bonus, this could have a significant tax saving. The key on this is that the bonus has to be as an inducement to sign the agreement. It cannot be related to the performance of the actual services for playing for the team, and it can't be considered compensation for the games in the future. And so this is there's a lot of litigation on this. There's some cases on this, a lot of disputes on this. There's some cases on this, pardon me. One of the early cases I was looking at was Nikolai Habibulin. And if you remember Nikolai, he was a goaltender. He was from Belarus, which was part of the Union, a Soviet socialist. It was a Soviet republic back in the 80s and 90s. So Canada had a treaty with the USSR and had somewhat similar language that the Canada-US treaty does. And so Habibulin got a payment as an inducement to sign with the Winnipeg Jets. He was a late round draft pick. Canada Revenue characterized the whole thing as income, subject to get taxed at our normal rates. Habibulin and his team were successful at appealing that the bonus was paid. That was a bonus was essentially, to sign a contract. It wasn't for performance. And in fact, if he didn't perform or didn't play, and it was right around the time the NHL lockout in 1994, he was entitled to keep it because it wasn't connected to his performance, and he was successful. That payment was subject to the Canada-USSR tax treaty, subject to a lower withholding rate. So it really depends on the facts. It really depends on the structure of the contract. And Brandon's going to talk at some length about his favorite player for the Maple Leafs, Jonathan Tavares, and the trouble he's in, and some of the Blue Jays players and some of the RCAs. So Brandon, I'm going to turn it back to you.
Okay, Steve.
I have no idea what's your favorite player, but
I'll leave it. I'll leave it there. You don't want to know. So Steve mentioned, obviously some strategies available to non-resident athletes. Some of them, there are certain risks and certain parameters or certain things that advisors need to do to kind of minimize those risks. And obviously one of those, probably one of the better planning techniques is the RCA, the retirement compensation arrangement. However, in certain cases, and I'm going to read a little bit verbatim here, just because the wording, the actual wording is important in terms of how that arrangement is structured and how it was worded. So in Jose Batista's case, currently, so CRA, they're contesting the validity of the RCA trust and basically disallowing the deductions claimed for those contributions, which basically means the amount that he had contributed to the RCA would be included in income in that particular tax year. So CRA's position is that the RCA basically qualifies as salary deferral arrangement, so you don't really get the the benefit of the RCA, and really the purpose was to defer the salary rather than to provide for the player's retirement. So some of CRA's or the Crown's arguments in the case was that the RCA did not provide a fixed or determinable amount to be paid after retirement. And again, you can imagine that, as a retirement plan, once you retire, that you would take money out over a certain period of time, as opposed to, liquidating or dissolving the RCA at that time. In terms of the agreements, that the player could direct how and when the payments from the RCA could be made. And the funds held in the RCA could be paid out as a lump sum. So again, not really meeting the definition of an RCA. So again, when structuring the arrangement and taking into account what might be considered a salary deferral arrangement, some of the issues to consider again is what's the intention of the athlete related to the country of residence at the time of retirement. The deductibility of the RCA contributions and whether the person was resident or non-resident at the time, if they're a resident of another country at that time, and at the time the contribution to the RCA was made, and again, considering the tax implications on the country where the person is a tax resident. And then also looking at the form and manner of distributions from the RCA at the time of retirement. And again, whether, say a lump sum compared to being payments over time. So again, you really need to look at the, kind of the structure of the arrangement. And again, to make sure that, the RCA is not offside and obviously, being in this position. Next slide. So our next polling question.
Yeah, and I think this is our last one. Go ahead, Brendan.
Yeah. So retirement compensation arrangements are useful for athletes, executives, high-income individuals temporarily resident in Canada, or all of the above.
I mean, it's interesting that RCAs are being challenged in these cases, and I think, as I understand it, you can treat these things as pension plans and probably be fine, but if you treat them as, I call them bank accounts or temporary measures, that's when you get into trouble.
Yeah, again, and well, obviously the Batista one is is sort of stands out, but I don't know, in your practice, have you ever seen one being challenged in that way?
I'd say we have, on the sense that I think when they went after some of these athletes, they kind of threw everyone in the net. And so, I think we're waiting to see kind of how these cases roll out and what Canada is going to do with the other assessments. And so the answer there is yes, it's all of the above. They can be effective, just depends on the facts and situation. So
yeah, I think we have a smart group attending today, Steve.
absolutely.
So now, as Steve mentioned, so I'm sure this has been in the press, so I'm sure some people have heard of it, if not most. So this relates to John Tavares, obviously a hockey player, the captain of the Toronto Maple Leafs. So CRA tried to reassess John on it was in 2018. It was a signing bonus of like roughly 15 million. And they basically he paid essentially the 15% tax on it. Whereas now CRA is saying that really it should be, since he was a resident, it should be included in the full amount, should be subject to Canadian tax. So I think the tax in question was roughly 6 million. And then, with the interest and penalties, it's coming to 8 million. So CRA is really saying that it's not, even though it may be called a signing bonus, it's really not a signing bonus, since if he left the team, he'd only be entitled to a certain share of that amount. And so again, it kind of seems that it's again disguised salary in a way. So obviously not, or potentially not entitled to the 15% withholding tax rate. Since there's probably a number of contracts that are probably structured this way, ultimately, if Tavares is not successful, this is going to have or may have ramifications for other NHL players who are kind of front loaded or loaded with these signing bonuses. But ultimately that still is meant to be will be played out. The thing I found interesting when they were like interviewing John Tavares, he was saying it didn't really, he wasn't worried about it. It didn't impact his playing in the playoffs, but I know that the people that are really worried are his accountant and lawyer. Because if somebody's gonna have to pay that $2 million, I'm sure those guys are worried.
Well, yeah, and there's been a lot written on this, and I think it's a really high profile case to understand not only the individual but the issues involved. One of my colleagues, Max Reed, who's a tax lawyer at Polaris Tax here in Vancouver, he wrote a really interesting blog article that kind of went through this, and he made a couple points I hadn't thought about. And one was just when you look at timing, this is a 2018 issue. This is the year he is a free agent from the New York Islanders. He signs with Toronto. Presumably, he was a resident of New York, so he's subject to U.S. federal and state, potentially city income tax on this anyways. And so the savings, is only the rate differential between New York federal, city, state tax compared to Canadian tax, still probably worth $1 million, $1.5 million. But to solve the problem, to fix this, is if you can win this appeal, great. But if you don't win this appeal, part of what you now have to do is go back in those years and amend your federal return and your New York or state return and your city return and say, okay, I paid a bunch of Canadian tax, and you're relying on those jurisdictions to agree. Now, the U.S. federal government probably would in time because there's a tax treaty between the two countries, and there's about a 10-year assessment that you can kind of go back. New York may not be so amenable, and so you may have a situation you pay Ontario tax, Canadian federal and Ontario tax. You might not pay federal tax, but you might pay state and local tax, and the pain might be quite problematic if you can't get a credit against New York state and city tax. In addition, you got this interest charge because it's been 6 years that isn't creditable anywhere, and so it's a difficult assessment and a difficult way to solve this.
For sure. The only other thing I would say is, even though, as we're kind of talking about that, the higher tax rates up in Canada, at least on, the other hand, we don't have, the state tax like the US does. So there's more of a savings at the end as opposed to currently.
Sure.
So,
absolutely. Absolutely. Hey, I noticed we're 10 minutes for the hour here. I want to leave a little bit of time for questions. Next slide, please. We're at the point where, again, please complete the survey. Tell us how we can improve. Tell us what other topics you'd like us to cover. We want to thank everyone for attending. We've got about 9 minutes for questions. Angie Feng is one of our managers, and she has, I'm sure, a few questions that Brandon and I can try and answer. Go ahead, Angie.
Thank you so much, Brandon and Steve. We've received some great questions from the audience. The first one is a non-resident athlete with Canadian duty days subject to only federal and surtax or federal provincial income tax?
Yeah.
Okay, I think I understand that one. Brandon, you've seen this before.
Yeah. So
go ahead.
So normally you would be subject to, if your income is not otherwise allocated to a province, you would be paying the federal surtax. But in this scenario, that income would be allocated to your province unemployment. So you would essentially, so again, for the Maple Leafs, you'd be paying Ontario tax on that duty day income, and the other provinces as well.
So you're paying Quebec tax if you're in Montreal. You're paying provincial. Interestingly enough, years ago, the NHL had one of their regular season games at Mosaic Stadium in Regina, in Saskatchewan, and those players paid Saskatchewan income tax on those game and practice days when they were in Saskatchewan.
Interesting.
Thank you. The next question is, how are endorsements sourced?
Well, endorsements are an interesting one in the sense that what we've been talking about today is payments from the team directly as an employee of the team that is going to be subject to tax, again, in Canada. If an athlete's not a resident of Canada, then they're not going to be subject to Canadian tax on endorsements, promotion, those types of things, unless they're some sort of their contract that they're specifically. Actually, I'm going to take that back. They generally wouldn't be subject to Canadian tax on that. And this is what. Go ahead, Brandon.
Yeah, sorry. No, I think you're in the right direction, because there's a bit of a gray area there, because you sort of get out of the kind of so you kind of look to the tax treaty and you kind of get out of the employment area and into the personal services. And I think that kind of looks to whether the person has a permanent establishment, which includes signing a contract. So I think if the contract is signed, or the way I would approach it is, if the contract is signed up here, let's say with a Canadian, whether like a CCM or Bauer, then we normally source that to Canada.
So if it's a Canadian-based duty or a Canadian-based endorsement. Okay. I know one of the things that happens a lot with athletes that get traded around and move around is that they're mindful of anything from endorsement income to investment income, and they'll often make sure they structure their affairs so they don't become residents of Canada and therefore aren't subject to Canadian tax. And so, for example, on the West Coast here, you'll see some of the American players that the Canucks sign. They'll have their home in Point Roberts, Washington, or they'll have it in Blaine, Washington, and they'll drive up for practices and they'll drive to the airport to fly, but they'll cross the border kind of every night to just further cement the fact that they are not a resident of Canada and therefore aren't taxed on anything but what the Canucks pay them on Canadian duty days.
Thank you so much. The next question is, can the RCA money be invested like any other registered account, stocks, etc.?
Well, in general, that's the case. I mean, there isn't any restrictions on that. It's not kind of a locked in. You're not, having to do certain types of investments, and so it's very similar to other Canadian pension plans. There's I want to say there's some administrative things you have to go through. There may be some actuarial things that you have to kind of get reports on, but in general terms, there aren't any restrictions on investments.
Yeah, and as a trust, the RCA, it has to file like a trust return, like a T3 on an annual basis, where it reports its income and expenses that it earns within the RCA or within the trust during the year.
Thank you. The next one is, if duty day is over 183 days, is that 100% taxable, or is it still prorate to determine the taxable income?
Yeah, two things. It would still be prorated to determine the allocation to Canada. Again, the only issue with the 183 days is you need to think about the residency and whether the person is a deemed resident. And again, that you would likely have to go to the treaty just to make sure that they have a closer connection, let's say, to the US, so they're not otherwise considered a Canadian tax resident. But yes, but it would be the income earned would still be prorated based on the duty day formula.
Thank you. And then the next one is a pretty big question. It's please address taxation of non-resident independent athlete contractors, such as golfers, caddies, tennis players, coaches, and others, withholding requirements, filing requirements, and provincial requirements.
That's a great question. Something I've been thinking about here. I'm going to turn that over to Brandon. It really does sound like its own podcast. Maybe it's part 2, but in a couple of minutes, Brandon, why don't you address that?
Yeah, that sounds like a treatise to me. Yeah, I think you have to sort of go back to first principles and kind of look at again the tax treaty. Is the person covered as an athlete? Is it independent personal services they're providing? So let's say the golfer. I would say for a golfer that's earning. I'm assuming they have an event up in Canada. You're signing sign a contract, whether it's with the PGA or with the event. So I would assume that income would likely be sourced and taxed in Canada. For the other athletes, that it would a bit beyond kind of the discussion here, but.
Well, and I think it is probably something we should address in a future topic. There's a U.S. tax court case I remember years ago. It was Retief Vucen, it was Sergio Garcia. It was two non-U.S. golfers that had played in the PGA Tour and had won events, and it was the taxation of their endorsement income. And I think it'd be a really good thing to try to explore that. So we'll do that at time. Angie, I think we've got time for one more question.
This one is from the question we received prior to the webinar. And what tax implications arise if a non-resident athlete becomes a resident of Canada during the tax year?
Well, as a short answer, all of them. But when you become a resident of Canada for income tax purposes, you're now subject to Canadian tax on your worldwide income and your worldwide assets. So that's everything from endorsements to commercial opportunities, to investment income, to maybe you got a rental place back home, you name it. Now you're subject to Canadian tax on your worldwide income, and duty days aren't as important anymore because it's all taxable here. So
awesome. Thank you so much, Steve.
Hey, I want to thank everyone for joining us today. We're just at the top of the hour. We've got our next series in a couple weeks, 2 weeks today. We got business tax. We got part 3 of our ongoing series, U.S. expansion to Canada. The QR code's up there. We'd love you to attend. And I want to thank everyone. I want to thank my guest, Brandon Vucen. And thank you to all the team here for that. And thank you and have a great day.
Thank you, Steve.